who you are, what got you interested in markets, and what you're currently doing with your research.
Thanks for having me. So for people that are unfamiliar, my background is a blend of engineering and finance. And so I've had a lifelong interest in markets, but my initial career was electrical engineering, and then I went into engineering management and managing the finances of an engineering facility. And then eventually I transitioned into doing macro research. And the way that I do it is I apply basically systems analysis to the economy. And so similar to how I would diagnose a complex electrical system or other engineering system, I try to use similar approaches on financial systems. And that comes up with a somewhat different angle of looking at things than kind of the cookie cutter finance approach I think that's out there. And so I just do my best to provide objective, independent analysis for people. A lot of my content's free, and then I also have a low cost research service.
Let's focus on the systems analysis point you just mentioned for a second, because I'm going to make the assumption, even though it's not something I've ever done, that electrical engineering and engineering in general, there's a clear link between knowledge, effort, and outcome. Right? There's probably less variability in the errors because there's a cause and effect there. We know financial markets obviously can be quite different. It's a chaotic system where butterfly effects can be pervasive and throw any kind of thesis off. How do you think about the dynamics in terms of market behavior, where there isn't a clear link necessarily as to why markets are doing what they're doing, except maybe with hindsight?
I think it's basically about isolating probabilities. And so as you point out, I do agree that basically it's a more complex system than anyone can map. There are a handful of areas such as, nutrition or climate or the economy that are just such complex systems. There's no way to fully model them compared to, human built systems that, despite being very complex, because they were built with human minds, they're, analyzable with human minds. Whereas with these more complex systems, the best we can do is map out a certain percentage of the terrain and then try to isolate kind of these if-else points. Like, if this happened, then this other thing's almost certainly likely to happen. And kind of to identify the bottlenecks and identify the pivot points of things that can happen. But it's all probability based. It's basically, I think it takes a certain amount of humility to say, okay, here's the analysis, here's the expectation, here's what would, cause me to change that thesis, or here's what would break that assumption, and kind of go from there. So it's about having a view, like a structural view, but then also updating it, week by week, month by month, quarter by quarter, based on ongoing feedback we're getting from markets.
The term mapping the terrain is an interesting one, because I agree with you, right? You've got to be able to kind of have a macro sense to see what's happening on the ground. But the challenge, I think, with a chaotic system is the mapping doesn't necessarily tell you the roads, right? So what I mean by that is this point I keep emphasizing, that it's less about prediction and more about path, sequence of returns when it comes to actual portfolio management and money management. And I remember a study I had seen, some kind of psychology test that was done, where a bunch of people were basically dropped off in a forest, and they were told, find your way out of this forest, and here's a map. But they were told the map that they were given was not the map for that forest. So even though the participants in this terrain were told, here's a map that has nothing to do with the place that you're actually at, it turned out when they observed the participants that they still relied on the map because they needed to anchor onto something. So I'm saying all that because there's a natural human tendency to want to try to look to history for examples that are similar to what's happening here, just to anchor on to some kind of conclusion for how this might play out. I've heard you talk about this before, Lyn, but for the audience, talk about your macro view in terms of how things have played out, especially this year, and if there's any real corollary in history to not just the terrain, but also the roads on the terrain.
So I think if people are unfamiliar with history, I've seen, for example, a lot of pundits, a lot of policymakers, a lot of analysts calling this period unprecedented. That's a word we've heard a lot over the past couple of years, whereas people that are familiar with financial history would consider this anything but unprecedented. It's just that the precedents, the closest precedents, are not really within our lifetimes, or at least our adult lifetimes for some of the older followers of markets. And so we have to go back essentially to the 1940s to find a similar environment. And that quote that's either accurately or inaccurately given to Mark Twain. Basically the one that goes like, history doesn't repeat, but it rhymes, I think is the closest way to think about this. That there's no period in history we can say, okay, here's how it happened, and so here's how it's going to happen again. It's saying, okay, here's a period in history. What is that? What happened there? Why was it interesting? How is it similar to the current environment? How can it kind of give us some sort of outline? But then also, what are the differences between now and then? And therefore, what are the most likely areas of deviation from then? And the reason I use the 1940s is because that was essentially the last time we had, this kind of 1-2 punch of a popping private debt bubble, which was in the 1929 crash, and then into the 30s we had a collapsing private debt bubble. Interest rates hit zero for the first time in a long time, and then we started to get rising populism, and then that rising populism contributed to global war, which then resulted in a huge fiscal response. And so the 40s, after disinflation in 1930s, the 40s were very inflationary. And that money creation wasn't from bank lending. It was from fiscal spending and the central bank monetizing that spending. And so if people ask, I got the question before, if I didn't know there was a virus and I just looked at charts today, what would I think is happening? I would describe it as wartime finance. That basically, we had a similar popping of a private debt bubble in 2008, 2009. Then we had a decade of relative stagnation. It wasn't as bad, obviously, as 1930s. Different technology, different monetary policy, no Dust Bowl, obviously. There are a lot of differences. But we had this kind of stagnating period, rising populism. And then, of course, we were hit by the pandemic. We had a war-like fiscal response to it. And then now we actually have the breakout of some degree of kinetic war. And so I view the 1940s is the closest parallel. It's also the only time in U.S. history where sovereign debt as a percentage of the economy is as high as it is now. And so we saw a very different response to that inflation from the central bank compared to what we saw in the 70s. And so overall, I think that's the closest environment. There are some differences, though. So, for example, back then, the United States was kind of in China's position. It was this rising emerging market. We were a net exporter. And so in many ways, the United States looks more like the UK did in the 1940s, if we were to be more precise with that analogy. But then even then, of course, there are multiple technology differences, demographics differences, structural differences that make this period different. And, when people think of inflation, they often think of the 70s. And that's the one that I try to somewhat shy people away from, because in the 70s, that inflation was very much driven by bank lending and demographics. Basically, the baby boomers were entering their home buying years. And so you had a ton of building construction. You had a lot of bank lending. That's where a lot of the money supply growth is coming from. Of course, there was a fiscal overlay on top of that, the whole guns and butter program. And so that was a very inflationary environment. The one, but it was different. So they were, debt was low. They were able to raise rates to deal with it. Just a very different environment than the 40s and that we have today. The one thing I think we can really get out of the 70s, though, is the energy situation. So in the 1970s, domestic U.S. oil production peaked in 1970. After about a century of persistent growth, it peaked in 1970. And so you had that money supply growth and that demand growth combined with a very real supply constraint. And so the United States became more reliant on foreign imports, obviously. That opened us up to geopolitical risk and scarcity. And so I'm finding a similar environment today where energy is the bottleneck for a variety of reasons. But then the monetary and fiscal side looks generally more like the 40s than the 70s. And again, these roadmaps are not perfect, but I feel like, if people are unfamiliar with history and are unable to identify the similarities and differences between those periods, then they're kind of totally flying blind, and they're going to view a lot of things as unprecedented and confusing when we have examples of history that we should at least be aware of to help guide us.